Nedbank came out with annual results today and headline earnings per share down 29.8 cents. That's to 933 cents. Earlier, Stephen Gunyon spoke to outgoing CEO Tom Boardman and asked him about whether the year was a tale of two halves.
You know, it hasn't been just a sudden shift. It's been a gradual improvement. So if we look at things like our credit loss ratio, which is worse than last year for the whole year, from 117 basis points last year to 147 this year. But at the mid-year, it was 157. So after 18 months of seeing it getting worse every single reporting period, this is the first time that it's turning down. And we've also seen that the consumer is still taking a lot of strain. But the consumers who were maybe 1 or 2 payments in arrear have now started catching up. But the ones who are kind of 3 or 4 or 5 payments in arrear, which puts them into default, are still not finding that, the ability to pay 2 payments in 1 month. So the South African consumer has still taken a lot of strain, and obviously there's more things in the system that would kind of say it's going to go on for a while yet.
So a couple of months into the new financial year, are you still seeing that strain? And how about the corporate impairments? Because we know from many of the banks, corporate impairments were lagging those retail impairments. Well,
I have to say our corporate divisions have done spectacularly well. Our large corporate business have impairments still way below what we would see as sort of through the cycle range, much better. Business banking, we expected our small and medium enterprises to start taking strain because they usually do before the large corporates. They had a very good year all in all and a very good second half. The very small business, the SMMEs, people who run small shops, often funded with mortgages on their houses, they're the ones still taking strain. But the corporate sector is in remarkably good shape.
Of course, you had 8.4% growth in your loan book in the second half of the year, made modest market share gains. Where are those gains? Where have you been making them?
In the corporate and business banking side. That's been where I think we've had a very good team on the ground, and particularly business banking, we have decentralized our decision making. We think the people on the ground know their clients better and faster turnaround times, and we've been gaining market share there.
But you do say you have been applying prudent risk appetite parameters within that lending.
Well, one has to, if you don't sort of learn from the tough times we've been through, well, when are you going to learn? So one has to be more prudent, and I think things like the residential mortgage market, where all of us went down a very wrong and unsustainable road of lending 100% of loan to value. That's an anomaly if you look over the last 30, 40 years in residential mortgages. And we've got to get back to, people have got to save, put a deposit down, and we'll lend the rest.
Of course, you say in the commentary that the strength of the balance sheet positions you to capitalize on growth opportunities. Are we looking here at organic growth opportunities? We know, of course, that you have taken on the balance of Imperial Bank that you didn't hold. What sort of opportunities do we have here?
I think we'll be looking at both, but certainly for organic growth, you need to hold more capital. And I think the most pleasing thing of our results this year is to see that our total capital is now sitting up, moved up from 12.4 to 14.9. That's a massive shift upwards in capital. And our core tier 1 capital, kind of shareholders' funds in essence, knocking at the 10% mark at 9.9. Now that's above what we see coming out of any of the new rules that might emerge out of Basel or the Bank of International Settlements. So we are well positioned for both organic growth, and should there be opportunities for acquisition, to make those as well.
And Nedbank today closing at 121 Rand 50, down 0.5%, pretty much in line with the broader market. As I said a moment ago, JSE all share closing down around about 0.75% today. James, Nedbank at 121, 122 Rand. What would you be doing with the stock, given the fact that, again, from its March lows, we have seen banks rallying substantially?
Terrific rally, and that's off the back that the fact that these banks don't have to take much risk. You look at the big international banks, they don't have that big fee income that they can fall back on. And if you have a look at Nedbank's results, it's a prime example of how South African banks make money and why they are not that exposed to the big international market movements. They make their money by traditional banking. They lend money and they charge fees. Fee income is very, very robust, which gives a good support base. But as Mr. Boardman says, it's the South African consumer that's under pressure. And South African banks have big exposures to those consumers. Impairments are up. and it's not going to get better. It's only going to get worse.
Tom Boardman has been there for 6 years. He clearly turned the company around. He is outgoing CEO. From next week, the position becomes filled by Mike Brown. He's obviously been working with Tom for a very long time. Do you think that the loss of Tom Boardman is going to make a significant difference to Nedbank, or is Mike Brown the right person, in your opinion, for the job?
No, I think Mike Brown is spot on, and Tom was brought in to, Mr. Boardman was brought in to do a particular job.
You can call him Tom. I think we can call him Tom.
I think he's old enough to be my dad.
I don't think we can call Ben Bernanke Ben, but we can definitely call him Tom.
I'll stick with Mr. Boardman. He's certainly done what he was supposed to do, and done an admirable job there. When he came on board, Nedbank was in dire straits. And it can certainly hold its head up with the other South African banks. The balance sheet is in far better shape, and he leaves the bank relatively well positioned going forward. But that's relative in the South African market as a whole, with this big exposure to South African consumers, which are going to remain under pressure.
He did say a sterling set of results in the corporate environment, and that the large corporates are steaming ahead as far as he's concerned. It didn't appear that he was concerned about a potential default in the corporate space.
Certainly, and that is positive news, yeah.
Massmart out with interim results today. Headline earnings per share down 20% rather, to 340 cents. Earlier, Alicia Seckham spoke to the CEO Grant Patterson and asked him about what trends he was seeing in the South African consumer.
The spending patterns have probably stabilized. The last 6 months has certainly been the most difficult 6 months in Massmart's history. But we're starting to see positive signs. So actually, we're starting to see shifts move the other way now, where people are getting back into spending on credit cards.
Let's take a look then at South Africa and what your plans are here. I mean, we're looking at a company where we know that your low-cost model has been a pretty attractive one in the past. What kind of strategy are you going to be needing to employ moving forward in order to weather what's left of the storm?
Well, we've got a good portfolio. We've got fantastic assets, we've got fantastic people, and we've got fantastic brands. So what we will be doing is shifting mode slightly. The last 12 months have been about protecting the income statement and the balance sheet. Sales growths have declined for the last 12 months, but we're starting to see a turn. So we're going to be moving back into things like format renewal, retail innovation, more promotions, aggressiveness in trading, opening up stores, and acquiring other businesses as well. So we're very much in an expansion mode now.
Let's talk about management and the role that they have to play here, because you've got to be focused on margin costs and stock control. I mean, just how tricky has cost control and inventory management become in this current environment?
Well, it's one of the things I'm most pleased about. We've invested a lot of money in supply chain, and one of the most difficult things to do as a retailer is, as your sales come under pressure, is to keep your stock aligned. And effectively, we've had zero increase in stock over the past 6 months, which is a testament to that investment and that discipline. On expenses, we've managed to grow comparable expenses by only 2.5%. This has been incredibly hard work. It's meant rescheduling labor, it's meant doing some things that we stopped doing some things, but we've managed to maintain our capital investment. So we're still investing for the medium and long term, but it's been a really tight and difficult 12 months.
Well, you've declared an interim dividend at 252 cents. Still, you're clearly optimistic about the road ahead. I mean, what's your forecast for the earnings in the second half?
Well, just to comment on the dividend, our cash performance was magnificent at growing cash generated from operations at 2.4%, a massive release in working capital. But looking forward, what we're saying is the second 6 months are certainly going to be better than the first in terms of growth on the prior period, and we've gone as far as to speculate that perhaps even we could grow earnings, or at least hold them for the year.
Massmart closing today at 90 Rand and 10 cents, up almost 2.5%, and certainly outperforming that broader market, again reiterating that JSE all share down at the close by 0.75%. This one has underperformed the market, and perhaps there's potential upside from a valuation perspective.
Oh, big time underperformed the market, and you only have to pick up the comment, most difficult 6 months in Massmart's history. Primarily because of the consumer being under pressure, has massively underperformed the market. I think what we're at 28% up since the March lows, where the market's at 43. It depends on your point of view going forward as to the impact of restrained consumer spending is going to have on Massmart. Is this discretionary spend or isn't it? Certain of their brands are discretionary spend, certain isn't, certain brands aren't, so you've got a degree of diversification there. But what I do like about Massmart in the slightly longer term are their expansion plans into Africa.